Most editors, weekdays at 8 a.m.
You're watching Bloomberg Quint. We're in conversation with William Foster, Senior Credit Officer at the Sovereign Risk Group at Moody's, and Aditi Nayar, Principal Economist at ICRA. They're in Mumbai here for their annual conference. Thank you both so much for speaking to us. I'm going to start with you. I think this is the first time you've done a public conference after your upgrade of India. I think the question that still remains is, are you confident that you made that upgrade at the right time? Because in the months since, if anything, concerns about fiscal prudence, immediate finances of the government have only sort of worsened.
Well, the key thing to remember is that decision was very much based on a medium-term view of India and the credit overall, and it's going to take time for the reforms that we cited as kind of key pillars of the expectation of the credit profile strengthening over time to take shape. So, for example, on the revenue side of things, GST, following demonetization, we expect that over time those will lead to things like higher revenue gains and improved tax collection, broadening of the tax base. The banking system issues, twin balance sheet issues obviously need to be addressed, but the IBC is now in place to, over time, help address some of those issues through banking NPL resolution. And we believe that some of the reforms will basically add to a higher GDP growth through an improved business environment and strengthening kind of investment flows, et cetera, over time. But again, this is very much based on a medium-term perspective and our expectation that the commitment to a fiscal consolidation medium-term story through the FRBM in particular will eventually lead to a stronger credit profile for India based on higher growth and a commitment to fiscal consolidation. So it's early days, remember that, but it will take time.
Would it be fair to call it a leap of faith? Because in each of these that you mentioned, GST, for instance, there are teething troubles. IBC, we don't know what the quality of or the amount of resolution money that they managed to get out of that. In terms of the fiscal reforms, India's track record of sticking to FRBM targets has not been fabulous. So, in some ways, a bit of a leap of faith from Moody's, right?
I wouldn't call it a leap of faith. We're not in the business of faith. Ultimately, it's a relative comparison of countries' creditworthiness. And India's has certainly improved over time, and the expectations that the policies that have been put forward and the reforms will continue to strengthen the credit profile relative to others.
Okay. Aditi, let me come to you on some of the more near-term fiscal issues. The FY18 numbers, now that we have the final fiscal numbers, tell you a lot of, jugglery is not the right word, but a lot of moving parts which actually went into meeting even that 3.5% number, whether it was railway capex, whether it was money that FCI was holding, or it was an additional dividend from the Reserve Bank of India. That plus going into a year which is going to be tough because of oil prices for starters, among other things, GST as well.
So FY19, it's too early to say anything definitive about how the year is going to pan out. All we can do is really talk about the points where we think that there could be some risks and the points where we're hopeful that we may even get better than budgeted results coming in. So overall, if we look at the tax side, it doesn't seem that the total tax growth is very optimistically budgeted for the year. We can argue about individual taxes here and there. Certainly GST, this being the first full year, we do need to see how the full year plays out. April and May have at least been encouraging in the sense that the numbers have been higher than what we saw last year. And once the e-way bill stabilizes, I think we are hopeful that we will get a good GST number for the year as a whole. Concern, as you already mentioned, is whether excise duties end up being cut because of higher crude oil prices. And we also need to be watchful of the dividends that come in for the full year and the disinvestment, because the target, although lower than last year, is still pretty significant. On the expenditure side, I think there are a lot of things that we need to look at, whether subsidies have been budgeted adequately, how much money is needed for the MSPs and the health protection scheme, and bank recapitalization.
Okay, but you're saying that you do expect them to stick to, it's early in the year, but as of now, looks like they'll stick to 3.3 for FY19. And will that entail expenditure cuts, and can the economy actually deal with those expenditure cuts? I think the last year's GDP numbers that came in show that it's still the economy is very heavily supported by government spending. Either of you.
So on the expenditure side, possibly what's going to happen is we're going to see more of things which are revenue in nature rather than capital in nature. So maybe we'll end up seeing a shift in the composition of expenditure, and that would support consumption growth, but not necessarily the best news in terms of infrastructure and capital spending. Revenue generation is going to be the key for whether the 3.3% target is met or not. It's just far too early in the year to really start making any definitive comments on that.
Just one more question on revenue. Have the GST numbers of the last few months given you any sense that the trajectory is moving higher?
Yes, I think with the April and May numbers, even though there has been a dip in May from the level that we saw in April, that was expected because the April numbers were essentially giving us an end of year and an end of quarter kind of a number that did spike up as we had expected it to. May number, the fact that it's significantly higher than the average for last year, I think is a good start for this year. As the e-way bill stabilizes, we do hope that this number is going to go even higher.
How are we looking on the external front to Moody's in terms of our reserve covers, whether it's short-term debt, import cover, forex reserves broadly in quantum? How are we looking?
So I think what's important to remember, obviously, is we look at India on a relative basis to other countries, and on a relative basis, India looks, kind of in line with the median in terms of the BAA space with regards to reserve coverage for imports and external vulnerability in general. We look at metrics in terms of coverage to external debt, for example, and short-term liabilities. India is in a much stronger place than it used to be. Let's say, comparing it to 2013 during the taper tantrum, reserves are at a much higher level. India does not rely heavily on foreign currency borrowing relative to some other countries. So dollar strength and kind of vulnerability to tightening of global interest rates and dollar strength is more limited than you might see in some other countries. But obviously what India is particularly exposed to is rising oil prices, given that it's a heavy importer of oil, and the widening of the current account deficit contributes to a greater need for external financing of that gap. But overall, I would just say that India is in a better position today to be able to deal with those headwinds than they were in the past.
What about the reserves to short-term debt cover? I think I saw a note suggesting that if you add the NRI deposits in, that perhaps the reserve cover on short-term debt is not as comfortable as you'd like it to be.
That's not true. I mean, we use a metric called external vulnerability indicator, which looks at basically reserve coverage to short-term debt, amortizing long-term debt along with NRI deposits, for example, and it more than fully covers it at this stage, and that's in line with the median for the peer group. It's close to about 70%, so it fully covers that, and ultimately, again, we see moving forward. With a larger reserve kind of buffer in place, the RBI has the capacity to deal with those flows.
Okay. Aditi, does it worry you that we haven't managed to see exports pick up for a fairly long period of time, one reason or another? We may have missed part of the global recovery. Imports have been high as well. Non-oil, non-gold imports have been high as well. Do those internal dynamics of trade worry you?
So trade, certainly, in the last year, we've already seen this big uptick coming in the current account deficit. Our estimate is that we would have ended FY18 at around $47 to $50 billion of a current account deficit, tripling from the $15 billion that we saw in FY17. So certainly the dynamics have not been great in FY18. At the same time, the really low levels we saw in FY17 certainly weren't sustainable, and they've proven to not be. Now going forward, with the rupee having weakened, I think, we are hopeful that exports will benefit from that. Some of the competitiveness of exports will really come back from a weaker rupee. Of course, the risk of trade wars is there right now. But at the same time, with the GST-related issues that exporters have been talking about settling to some extent, I think that's another tailwind that could be there for Indian exports. So we're hopeful that part of the increase in our current account deficit from higher oil and other commodity prices would get offset by better exports and remittances.
Okay. Just last point on growth and inflation. We've turned the rate cycle. We've seen the rate cycle turn finally. Do you have a sense on how high you would rate the risk of inflation sort of surging up and the MPC not being able to meet its targets? Where would you rate that risk on your radar?
I would say that risk is relatively low. I mean, one of the key supporting features of the sovereign credit today is monetary policy. The policy credibility and effectiveness has really improved quite a bit over the last few years. I think the implementation of the flexible inflation targeting regime and the MPC have really added to the RBI's credibility in being able to fight inflation. And if you look at, obviously, CPI inflation over the last few years, it's come down from double digits to within the range of the target. That's a big deal for India, and it certainly contributes to greater macroeconomic stability and the capacity to anchor inflation expectations, as well as be able to better fight issues, external headwinds that may be at the fore.
All right, and growth is looking good, Aditi. So, I mean, if we manage to, cap inflation at reasonable levels, and growth seems to be picking up. I think yesterday they said that the output gap is nearly closed. So, positive on growth?
Positive on growth. I mean, certainly we expect there to be a V-shaped recovery from the 6.7% levels that we've seen for last year. So we are hopeful that growth is going to consolidate above 7% in FY19. But there are a couple of headwinds. The higher crude oil prices would impinge on the purchasing power of consumers and the margins of producers as well. Interest costs are going up. There is still a risk of trade wars as well. So there are risks on the horizon, but we do think that we're going to get at least a 7.1% GDP growth in FY19. So a V-shaped recovery is in sight.
All right, I'll leave it at that. Thank you both so much for speaking to us.
Thank you.